I would now like to take this opportunity to officially properly introduce Mr. Amey Mashelkar. Mr. Amey leads JioNext, Jio's startup accelerator program. Over the past 6 years, he has been instrumental in advising over 160 technology startups in their product market fit, fundraising, go to market, and scale up strategy. In his current role, he mentors global startups in positioning their value proposition for strategic partnership with Jio. Mr. Amey was an entrepreneur prior to joining Reliance and also supports startups by angel investing in a personal capacity. He is an economics graduate from Delhi University and executive MBA from Asian Institute Management, Manila. So, welcome on board, sir. I would also like to bring this to your notice that if you would like to ask any specific questions, please drop a message to me and Bhavya, and we will take your questions once sir is done with his session. So, feel free to put forward your questions. Over to you, sir, and welcoming you.
Thank you. Thank you so much. Sorry. Thank you so much, Priya. And, really, it's wonderful to be here today amongst all of you in these very challenging times. And it's very nice to see how the alumni actually has gotten together on this evening and with the goal of meeting each other and encouraging each other and propelling the institution forward. So thank you, Shraddhaji, for inviting me, first of all, to this session. And it was wonderful to listen to DG sir on his remarks. One thing that stood out is the 1800 alumni that you all already have, which is a significant resource for the institution. And also encouraging to know that alumni are interested in investing in other alumni startups. So that is also a very, very encouraging sign. And I applaud you for that. What I'm going to do today is not talk very broadly about entrepreneurship alone, but I'm going to talk very specifically about the world that I come from, which is the startup world. And the startup world is fundamentally slightly different from, uh, you know, the typical entrepreneurial uh, family-run businesses that one gets to see. So I'm just going to deep dive a little bit into that space. So last year, Indian startups raised $9.4 billion. There were 881 startups that raised that amount of capital from around 1,476 investors in the ecosystem. So as you can see, there were more investors chasing fewer startups, almost half, right? So obviously there is a lot of capital that can go into startups, but very few fantastic ideas to invest in and fantastic teams to invest in. So more capital and less startups is always better than the other way around. um, I just sort of moving on to what we do at JioGenNext. So JioGenNext is an accelerator program, as Priya introduced. What are accelerators? Accelerators are essentially programs that can help budding entrepreneurs to raise capital very quickly. There are accelerators such as Y Combinator and Techstars, and there are several accelerators in thousands now around the world within academic institutions as private enterprises also that are helping startups raise capital very quickly. JioGenNext is a customer and investor access program. So where we are different is that we, first of all, are leveraging the vast resources of Reliance to help our startups. So whether it is in terms of helping them with, an early validation of their product, to become an early customer for the startup, to help them with a partnership that can help them grow fast, or even sort of invest in them at an appropriate time. So one of the examples that I can give you is of a startup called Intello Labs. This startup, is a 2017 graduate from our program. And when they came into our program, they were only at a very prototype stage. We looked at their product and we saw something very interesting that they were trying to solve in the retail sector. It was very specifically, it was about a computer vision product that could automatically tell you, automatically sort and grade commodities such as potatoes and tomatoes, etc. So we saw the potential for this because we wanted to improve the quality of the produce that we sold through our Reliance Fresh stores. So we used that prototype and we helped them develop that technology further into a full-fledged product. And I'm very happy to see that today that product is rolled out across all our Reliance Fresh stores across the country. That whole prototype to product journey was a very important one for them to go through with a live customer, which is very important. I mean, you can do all sorts of experimentation in lab, but when it comes to real customer environment, it's very different. And it took them almost a year, but I'm very happy to see the way they have progressed. They are now present in several other retailers with the product. The company, in the middle of the pandemic last year, around May, they raised their Series B round of funding of almost about $6 million, and now they are aspiring to be a global enterprise. So those are the kind of stories, and we have almost out of 160 odd startups that have graduated from our program. There are about 50 plus startups who have gone through a similar journey with us in JioGenNext. So I just want to quickly move on, and I have a few data points that I want to cover on startups and funding, specifically because we have the alumni group here, which could be interested in funding other startups and also could be doing their own startup as well. So what is a startup? According to me, it is an organization that can grow very fast, non-linearly, and the cost of serving every additional customer comes down as the user adoption grows quickly, right? And this is a startup is an organization that can grow faster than most organizations take to develop, which is normally around 10 to 15 years. But as they say that in reality, every great company was built overnight in 10 years, right? So it does take a significant amount of time for a company to become big. But at the same time, a startup is something that can quickly disrupt a space or bring an alternative to the market, in a very disruptive manner, right? And grow very quickly. So we try to look for such traits in the startups that we want to engage. When is it really necessary for a startup to raise capital, right? Because the next question is, okay, you may have a clear understanding of your customer, but to grow, you need capital, right? So the first rule that we talk to startups about is that you should not raise when you are running out of money or you have already run out of money. You should raise when you have at least 12 to 18 months of runway, so that you can get a better valuation for your startup. And what do you need the money for? It's primarily in technology startups. It's for two things: meeting fixed costs, which is salary, software, and cloud, if it's a technology-driven startup. And if it's a hardware, then hardware software combination startup, then you have to meet your inventory costs. So those are really the big reasons, like 70-80% of the reasons why a startup really requires money before revenue can start paying them, right? So what are the different types of funding rounds that a startup goes through? So seed and angel. So I'm sure that a lot of alumni members out here would be interested in investing in this stage, which is about 25 lakhs to a crore at a very early stage of the startup. There is then the pre-series A or the bridge investment space, where typically 1 to 10 crores of funding goes into a startup. And then beyond that, you have something called series A. So what do investors, and then of course after series A, it goes on to B, C, D, so on and so forth, right? Uh, what do investors really look for across these stages that I just talked about? At the angel stage, it's really just a good team, right? You're just looking for a team because the product is unproven, the market opportunity is suspect, everything that you say is an assumption and a hypothesis, nothing is proven. So all that we can bet on at the angel stage is really really on the team and the potential market opportunity. These are just the two things. So therefore, investors take risks around the team, the product, the customer, the market, and execution. All these are big risks at that stage. And typically at the angel stage, startups have to achieve what one likes to look at as a founder product market fit, right? So whether the founder starting the startup is well suited for building that startup is the only thing that actually matters in this stage, which you should be able to accomplish with an angel round of funding, right? The Series A stage, typically the risks go down. So you are left with only market and execution risk at this stage. And typically the focus of the start at that stage, basically the startup should have achieved some kind of a product market fit, which is that the market is really pulling the product from you as opposed to you trying to push the product into the market, right? And you're growing organically or growing virally. There is no friction in the customers actually coming and paying you for your product or service. And Series B and beyond is typically where the risks associated are more around execution and scale up, right? And that attracts a lot of growth type capital, which is very large sums of money. So typically investors look for signals, right? There is a bit of a herd mentality where if one investor gets interested in a startup, then other investors will also join in. I have seen cases where a startup has been in the market to raise capital for a year and a half. Everybody rejected that startup, and then suddenly one VC got up and said, "Okay, you may be onto something," and maybe because the traction improved or some other data points were there at that point in time, and then once that one investor gets interested, then others kind of quickly join in. So just moving on, I just want to go from a startup view to now, uh, why it's important to understand the investor view as well in terms of investing in startups, right? So typically, if you are an angel investor, like many of you could be in this group, um, what are the type of returns that you look at for your money, right? So one is obviously the standard fixed deposits in government bonds, etc., which give you single digit interest. Then you have public markets, which could give you double digit return through equities and mutual funds and so on and so forth. Typically for alternative assets like private equity and venture capital, people look for returns that are more than 20%, right? And then of course there are other new emerging categories of investments which are very speculative, like cryptocurrency, etc. uh, Venture capitalists are essentially money managers, right? Somebody else gives them money to manage, and they have to return that money with interest. I mean, it's a very simplistic view of looking at things. And these investors are investors who give them money are typically pension funds, family offices, insurance companies, etc. But less than 5% globally are allocated to alternative assets. So one of the biggest sources of funding for venture capital are essentially your universities and institutes such as yourselves. Harvard, Stanford, etc., have huge endowment funds that invest in venture capital funds, and that kind of creates a virtuous cycle because you're a university that's creating entrepreneurs, and you're investing in money managers that are investing in these startups who go on to become very successful. They could be a lot of alumni of yours, and because they become successful, they plow that money back into you, into your endowment fund. So it's a virtuous cycle that gets created, and this works very well in Silicon Valley and in the US specifically. In India, it is yet to work in a significant way. Quickly, I just want to take you through what a VC's business model is. So let's say that depending on how much time we have, I've been given half an hour, but I just want to take you through some very quick points. uh, how does the VC's business model work, right? So if let's say a VC manages to put together a
म्यूट कर
100
दिया
crore
बोल
fund.
बोल रहा था आपका ये अगर समझो सैटरडे संडे जैसे एक आध
Sorry,
दो दिन
can I go on?
Just
So how does a VC's business model work? So if they have a 100 crore fund, they have to generate at least 300 crores on that 100 crore fund. I mean, I'm just making this very simplistic for the sake of making a point. The investable amount is about 80 to 85 crores because they take a management fee of about 2% every year over the life of the fund, which could be 7 to 8 years. In certain cases, it is more than 10 years as well. So on a multiple on invested capital basis, they have to deliver a 4x return on the 100 crores, right? So out of the 100 crores, let's assume that 80 crores that one can actually invest can be invested across 10 startups. Let's say 5 crores on each startup. So you have 50 crores going into 10 startups, and 30 crores as reserve capital for follow-on rounds to maintain your position in the company. Typically in the VC world, there is a 3-4-3 thumb rule. 3 succeed, 4 struggle, and 3 fail. I mean, this is again very simplistic view, but sometimes the odds could be in your favor. Sometimes, this is how it works. And sometimes, it could be that a lot of majority of them struggle and fail. But typically, if you were an optimistic VC, you would look for a 3 succeed, 4 struggle, and 3 fail kind of a model. And so 3 startups literally have to deliver a 300 crore of return to the VC. So if you consider 100 crore of return per company, and if the VC holds 10% of the company at the time of exit, it means the company has to be valued at 1,000 crores. For a 1,000 crore valuation, the company has to have a revenues of at least 100 crores at the time of exit, right? So less than 1% of the venture funded companies reach 100 crores revenue mark. And there are almost, like I said, 1,500 VCs in India that competed for 881 startups. So more VCs than fundable startups. So you can see that, the odds of success are very low for for VCs. Therefore, every ball that they hit, right? I mean, if you have to use cricket parlance, they have to hit every ball for a 6. And that is how they need to go out batting, right? Like many of our youngsters that we see in T20 matches nowadays. So that is typically the life of a VC. And then how do VCs make money? End of the day, they make money when startups get acqui-hired or acquired, one of the two. And acqui-hire is a new trend that has emerged in India, but it was always there in the US. But it is now emerging in India in a very big way, because what is an acqui-hire? So from a startup's perspective, like many of your graduates or even alumni members, if many of your fresh graduates, rather than, for example, after learning entrepreneurship, they want to do a startup, it is definitely, and if their economic situation is such that they are able to do that, then it is better than getting a job. And because the combined value of what you can do as a startup would be much more than individual job value, right? So if you let's say two of you come together and start a startup, and you build some technology that is very interesting for one of the big tech companies, they can come and they can say, hey, look, we really want you to come and work for us because you built something very, very interesting. So here is a salary component for you, and here is the additional component that can go towards what you built, because this is something that we cannot build in the same amount of time that you've been able to build, right? In Silicon Valley, typically an engineer, an AI engineer or a software engineer per se, in big tech companies, typically would get about $150,000 annual salary. Plus, that person would have about $2.5 million worth of shares that are vesting, essentially. So India, this trend is just starting out. So, about $2.5-3 million per engineer is how they even look at startups. So your startup has how many engineers? Okay, so many engineers into $2.5 to $3 million per engineer is my cost of acquiring your startup. That is typically how it works. And that form of acquisition is coming in India, both in terms of cash as well as stock. Other forms of exit are, of course, M&A and IPO, which are very rare, because for M&A to happen, the company has to be significantly large. For IPO also, the same case, you have to prove profitability over 3 years, etc., etc. So just moving on, I want to quickly deep dive into, is it really necessary if you're a startup, do you have to raise capital from VCs? Well, there are examples like Zerodha, for example, online stockbroking firm. They deal in futures and options stocks, IPOs, and mutual funds. They made some 400 plus crore net profit. And recently, in fact, just yesterday, I read the news that the three main founders announced to give themselves 100 crore annual salary each, right? So, and this may have taken them about 10 years to build this startup. Obviously, they were in the right place at the right time with the right value proposition, and they were able to grow profitably. And so they never needed any capital for growth. But there are examples like these as well, and you can also go down that path as a startup, right? If you focus on customer revenue, no issue. You can keep going down that path. There are other challenges of raising capital also that I alert budding entrepreneurs about. So one is, the rights of investors. The due diligence process is very hard. The only asset is really founders in the startup. So investors can be very demanding on founders before and after the investment. And there is always pressure of delivering outsized returns. Always there is that pressure. And in India now, one can see that so many startups are getting multi-billion-dollar valuations. So valuation growth has accelerated really fast, and the company growth is still going as per the market. So that is a typical thing that happens with raising capital from investors. But that's the nature of the game. The best way to reach out to VCs is through references. They work on references, VCs normally, because they get inbound email every day from hundreds of entrepreneurs. It's very hard for them to distinguish one startup from the other. So a reference always works. In fact, they attend so many pitches that I once heard when I was at an event in Israel that one of the top partners actually slept right in the middle of a pitch made by startups. So that's the number of pitches that they have to see every day. So attention is really, there is a huge attention deficit now, and you have to really stand out very quickly. And therefore we insist on our entrepreneurs that they create decks that can deliver the value proposition in not more than 2 to 3 minutes. Angel investors are the best source for introductions to VCs. Of course, there is LinkedIn and attending events. If at all, events start the way they used to be, again, hopefully it should start again very soon. Um, if you were a startup and you asked me the question, how much should I invest in my own startup? Because we've talked about other investors coming and putting money in you. I think it's very important that a startup has a go all in kind of approach. As long as you're not mortgaging your house or other assets and putting other people in difficulty, I think you should go all in. Equity is extremely risky, but you don't just follow your passion blindly, but you also need to think like an investor yourself. Can you return yourself the money that you're putting in? And it's not just cash that you're putting in, but it's also your time, very valuable time. And so I always recommend entrepreneurs, and especially graduates of EDIIAA, if you can encourage graduates to start early. If they want to do a startup, they should start early, because they get then enough time to fail, to experiment, to fail, to get back up, dust off, and keep going. So the sooner you start your entrepreneurial journey, the better it is. Not at the cost of your education, but of course after education. I just like to end here. I'm sorry, I just breezed through a lot of data points, but just want to end here by telling you all what we are interested in at JioGenNext. We are looking at two levels, simplistically put. One is application of advanced technologies like AI, ML, blockchain, AR, VR, IoT, 5G, and quantum computing, etc. So that's a horizontal layer that we are focused on. And of course, industries that are very interesting are education, healthcare, retail, media, telecom, networking, etc. These are some of the very interesting industries. Commerce and retail is a very big focus for us. And of course, these are some of the other areas that we are looking at. So the contact information is there on JioGenNext.com. You can write an email. There is an application form that you can fill out and send to us. The way the program works is that we used to do batches until last year, where we could accommodate about 10-11 startups per batch. Now we made it more continuous. So the minute you want to apply to us, we bring you in that month and present and work with you to position your value proposition to our stakeholders internally. If there is a meeting of minds and there is a proof of concept that you can do, then you can move forward. Once a proof of concept is done, then obviously you get into a more commercial kind of a partnership. And we are doing this across all these sectors that I talked to you about. So you don't have to wait for a batch to happen. It's a continuous program now, and we are planning this year to bring in at least 200 startups into our ecosystem. hopefully about 25-30% of them would convert into deep engagements. So I'd like to just take a pause here or take questions. But thank you very much for this opportunity. It's been great to interact with all of you, and happy to take questions. Thank you.
Thank you, Mr. Amey. That was quite crisp, I would say, considering the details that can be shared on such a topic. Um, I have a few questions coming in, and I would like to share them with you. The first one is an interesting bit which says that is it actually a myth or a reality that it is easier for IT firms to get funding compared to people who come up with ideas based on manufacturing or which involves hard assets?
Yeah, that's a great question. I think technology is going into all sectors. Um, the reason why funding is attracted by sectors that use technology is because you can grow faster with the use of technology. So even if it's a manufacturing idea or a services idea, if you are actually using technology in a big way to accelerate your business model, then there is always opportunity for raising capital. I mean, I would just put it broadly that way. But of course, I mean, it all depends on a case-to-case basis.
Okay, so can we summarize it that we need technology innovation involved in any idea that we come up with?
Absolutely, absolutely. I think technology is central to everything that we're doing in this world today.
Thank you. Another one. Is there a timeline that as in at what point is it the right time to approach an investor? Say, for example, if a company, has been working on an idea, but is unable to make profits, right? Say, for example, they've given 1.5 years to an idea. They're working on it, trying to put it in the market, but not making profits on that. So will that be the correct point if they believe in their product market fit?
Again, I mean, this is a nuanced answer, but it depends on your situation. So if you're in a very big market at the right time and you have a fantastic team that's working on solving a very hard problem, then I think investors are patient and they're okay if you're not making revenue or if you're making little revenue. But if you get the sense that you're struggling in making your idea work in the market where there is no monetization uh, because of no demand from the customer or from the market, then investors can sniff that out very quickly, and your startup won't go anywhere. So it really depends on your situation, but I would my thumb rule for startups is from start to monetization should not take more than 6 months for you. Uh, if
That
Yeah.
that really gives a good timeline, 6 months. Okay, last one that I have is if you could give, 2, 3 items on checklist that before you're presenting it to an investor, what should you have in hand? Just a quick checklist on that.
Yeah, so the checklist for me is the problem real that you're trying to solve. Uh, you have to you have to make it believable. And if the problem is hypothetical or if it's unproven, then you have to find a way to prove it. So first is the problem needs to be real. Second is you need to have a fantastic team that can solve that problem, because at that point in time, the only thing that you can show is really the really a team that has the potential to solve that problem. So your communication of that idea and your energy and passion and that should very, very clearly come out. And obviously, if you're in B2B, then your expertise should be seen. So a great team and a very big market opportunity, so that even if you go wrong, you won't go wrong completely. I mean, if you go wrong in $100 billion market, it's fine. But if you go wrong in a $10 million market, it's really bad, right? So these are the three things. The problem should be real. You should have a fantastic team with you, and the market opportunity should be massive.
So by market opportunity, do we consider the projections of financials here? That
Yeah, I mean, some amount of. So let me give you. These are signals actually. These are signals, and typically there are moments when a market opportunity becomes big, right? Disruption takes a long time. Market opportunity suddenly emerges sometimes. So I'll give you an example. In the last 1 year, one and a half year, you would have seen that whether it is K-12 schools or whether it is higher education, institutions, or whether it is, upskilling programs and professional learning programs, the edtech wave has just, come and swept all of us, right? And that happened because pandemic was the turning point for this industry. It's not that edtech did not, but it just got accelerated and the market opportunity became very big because of the pandemic situation. So, so you have to be in that market at that point in time and cannot miss such waves. Another wave that happened in the past was the demonetization wave, when all these payment aggregators, payment gateways, payment wallets actually got a lot of lift, right? So you have
Yeah.
to look, and some of these are unfortunately unpredictable. Some of them are predictable waves that come. For example, Geo was a predictable wave, right? Because we suddenly went out there and created broadband, for the country, and suddenly so many apps and services that were previously not possible became possible. So that was a predictable wave that happened. So the market opportunity is really a signal, and it's a wave that you have to ride, uh, especially when you're a startup. So
Thank you
it's
so
it's,
much.
it's
And
just to clarify, it's not so much to do with your financial model. Financial spreadsheet models can be changed, and they're only
okay,
on paper.
thank you so much. I will now pass on to Bhavya for her to ask few more questions that we have in our
Sure,
chat box.
sure.
So we have got two questions here. First question is guide on funding FMCG sector. Could you please guide us on that, sir?
I'm sorry, I missed the first part of your question. Could you repeat that?
Could you please, yes, sir. Could you please guide on the funding opportunity for FMCG sector?
Funding opportunity for FMCG. So it depends on what you're doing in FMCG. Very recently, I saw an interesting idea being funded by some blue chip investors that looked at completely digitizing FMCG model. Right? There is no, um, it is the entire distribution is all digital, and it is no like physical assets on the ground. So that makes it very asset light. So if you're not using technology in FMCG, it's very difficult to come out with a fundable idea.
Yes, sir. The second question is, sir, what do you think about blockchain usage in agriculture for end-to-end supply chain tracking as well as remuneration to farmers in terms of closed tokenized economy? What will be the acceptance, if at all, benefits and challenges?
Yeah, so I think blockchain is a very interesting area and it has wide-ranging applications. We are very interested in looking at blockchain ideas. So if there is somebody who's building something in blockchain, happy to talk. Uh, what we feel is that uh, the challenge in so blockchain is divided into two parts today in this world. One is of course the whole cryptocurrency world, which is all B2C and tokenization of these crypto tokens essentially, which can be traded on exchanges, etc., which is highly speculative and it has no intrinsic value. But it is growing phenomenally. And the second part is which is more enterprise and more B2B focused blockchain use cases. Um, in the enterprise and B2B blockchain use cases, see the fundamentally where blockchain has succeeded is where uh, the transaction is of significant value, right? And if the transaction is of a significant value, then applying blockchain makes a lot of sense. So within agriculture, one has to see, what is it that you're actually tokenizing, and is it of value to that supply chain, and whether it is in terms of the time for that commodity to get perished, and whether creating a blockchain around it would create some efficiency that would lead to more transparency and enhancing the value of that trade, or whether it is some other use case that you're looking at. So it's very specific to where you're trying to apply this. I'm happy to evaluate it if you reach out to me independently and we can look at it separately.
Thank you, sir. There is one last question that we would like to ask you. That is, if somebody wants assistance only in marketing aspect of it and not the investment part, can they apply for the accelerator program?
Yeah, absolutely. I think we are a customer and a market access program primarily, where Reliance can become a big customer for you or a partner for you in your growth. So definitely, I mean, you should. That is the number one reason why you should apply to our program. Investment is something that we do very selectively, only when the startup reaches a certain uh, amount of maturity.
I think members are not completely satisfied, and we have a lot of questions flowing in. So I will take the liberty of sharing one last question, and I assure you this time it's going to be the last question. Go ahead, Bhavya.
What are the sunrise startup sectors according to you?
I think every sector that can potentially use technology to create efficiency and create new opportunities for growth is an interesting sector. I would not discount any sector today, right? Imagine like in agriculture, for example, there are so many interesting things happening in the agri space, and it's a multi-century old business model, right? But today there is technology being used to provide fantastic value to the farming community and the entire supply chain. And so therefore, any sector can benefit from the use of technology. What I feel is that technology itself has its own cycles, and you should be at the sort of on the uptrend of a technology as opposed to a downtrend, right? And where startups go wrong is they adopt technology, the kind of technology when it's already on a downtrend and its life is very limited. So that's where you need to be careful. You need to technology has its own cycles and its own seasons, so you have to really catch it on its way up, really.
Thank you so much. As promised, no more questions, and we will reach out to you in case we have few more questions offline, definitely. But it was a great pleasure listening to all this, and I'm sure we benefited more than we had expected with this session. I would like to share a small video that gives a glimpse of our last virtual meet, and hoping you would enjoy that.
Thank you so much.